So let's start with today's webinar, which is on performance evaluation, which we will be looking at through ratios and a brief of theory about it, why they have been created, and I'll try to give you a glimpse how you can create your own ratios deciding upon how a strategy performance is. And second part of it, we will looking into the money management. We'll look at few traditional techniques and we'll try to understand how we can utilize them in our trading. So we welcome you on a webinar by QuantInsti. I myself, Shaurya Chandra, I have been associated with QuantInsti as well as iRage, which is a company which is working closely with the QuantInsti. I have done my engineering from IIT Roorkee and done my MBA from IIM Ahmedabad, and have been working in the algo space for the last 5 years, and have worked out with the various firms helping out in their algorithmic trading strategies. And as the QuantInsti, which is the organization which is bringing you today's webinar, is working towards educating the new this new technology, that is algorithmic trading, which is very new in India, and it is being propagating the how well the algo education can help you out in your trading. So we do carry out courses which I will talk to you in some time. So this webinar is being brought to you to give you some education about how the performance valuation ratios and money management helps out, and how you can really add into your algorithmic trading to arrive at a desired result. So let's begin today's lecture. So when you are building a diversified portfolio, how you really go about it? Do you look forward to do something the kind of throwing dart at the dartboard and deciding upon how much to allocate to currencies, to bonds, which stocks, to buy gold? So are we working something like that based on some chances, some kind of a random number which comes over to our mind, or we come around with some kind of a definitive method to evaluate whether to invest in a particular strategy or in a particular kind of stocks? So that's the idea behind with today's lecture. Now you have done the back testing, you have done your analysis, you have created your own data set of say past data, and now you look forward to see how well the returns are for a different kind of strategies and which one you should start putting up money with. So that's where this theory of strategy analysis and various ratios come into play while understanding into how the strategy is useful for the market perspective. So let me just start with the strategy analysis, which is we will be looking it into absolute risk adjusted return measure, that is Sharpe ratio, Sortino ratios, Calmar ratio, Sterling ratio. I'll just give a brief introduction about each of the ratios and how they really try to capture the different scenarios in the markets. Relative measure ratio, there is a up capture ratio, down capture ratio, up number, down number, proficiency ratio, up down. Relative risk adjusted measure, that is your trainer ratio, and tail risk measure that are thereof based on VAR technology. So before I move ahead, there is always a kind of excuse me. Okay, there is always kind of always a trade-off between risk and return. So if you increase your risk, your returns will increase. If you decrease your risk, your returns will decrease. Similarly, if you try to gain as much as possible, of course your risk will always increase. So how you balance it out, that is the question. And to answer these questions, these ratios have been defined. So let us see how these ratio defines various risk and how they look forward to capture it. So the first one is Sharpe ratio, where excess return over risk-free rate, that is standard deviation, is being calculated. So what we are saying is, if we increase the standard deviation of our returns, with that increase of the returns, we calculate the Sharpe ratio. So it is RP, that is a return of portfolio, minus RF, that is a standard risk-free rate which is available in the environment, divided by sigma. So what we are saying is how much extra return for per increase in the sigma we are ready to take. So if you have higher returns and a low sigma, then your Sharpe ratio is higher, and with a higher the Sharpe ratio, better it is to have the strategy, since it will be showing you lesser variability in your returns. It provides very excuse me, Sharpe ratio provides very useful information regarding the returns of an asset for a given risk. But what are the various kind of I would say limitations, because the Sharpe ratio has been in vogue for a long time, but there are some limitations and some kind of drawbacks where this system looks forward and does not give you a very clear picture. So where it comes to be a lower side is, it is based on the historical data. So we assume that future will be the past. So RP, which we are looking at, is the excess return, which we see that the average, say, CAGR, which a strategy has given over the past few years, and we try to equate it inside that fashion to see how much it will return. Poor at estimating tail risk, that is normal distribution, hence no differentiation between the positive and the negative trade. So what we are talking about out here is that where we have a sigma, which is your variability of return, so you might have a variability of the returns on the positive side also. So that is also being added here, rather only the variability on the negative side. So it is that both the part is being captured here. Just a second, I need a uniboard. Can I have a uniboard here? Yeah, sorry guys, just a second. Uniboard. It's not visible here. Okay. So what we are talking about here is that in this kind of things, if these kind of tail risks are not being they are also being penalized if I am having a variability on the positive side. Now coming back to it, what are other things that it doesn't account for? Drawdowns, that is leading to the low volatility and the transaction cost. So what are the drawdowns? Drawdown is something like if you have invested certain amount of money, say 100 rupees into your strategy, how this money have gone in the period which is say something like 2 years. So how well this has gone. So the drawdown will be something like this, how much it has gone up and it comes down by a certain amount. So this is what is called a drawdown, how much money it has lost in a particular losing streak. So the strategy will not talk to you about, rather this ratio will not talk to you about how much drawdown you would have seen. Then we have a slight change which is called a Sortino ratio. Here there's a difference between the expected returns and expected risk-free rates have been taken, whereas the standard deviation is only taken for the trades which are negative. So what we are talking about is the variance which are on the negative side is being considered. Hence, once we have considered those deviations, we are not penalizing the strategy for high variance if the returns are on the upside. There is this modification in the Sortino ratio. So as I already said, that what is the problem with these averages? You can always say, oh, my strategy is making a 3% returns, but there is a classical flaw of averages, like when you go about, you can have this which diagram shows, you can have that risk of sinking, and which is something which happens because of the maximum drawdown. As I showed you maximum what is drawdown, I'll just show you what the maximum drawdown against mean like, and we will be discussing it in further. Is something like I invested 100 rupees, my strategy made 200 rupees, and it came down to say 110, and then again made 200. So if you would have looking between these two state, that is say 1 year of time, so you will say, oh, my strategy will have given me 200 rupees as return, and over 100 is something like whopping 200% returns. But there are times where you would have made 200 but have lost something like 90 rupees, that is something like for 45% from the peak. So from the peak you could have had the maximum drawdown of 45%, and this 45%, if not being well worked out, could also lead to the ruining of the fund. So many funds who have not worked out their maximum drawdown well faces the chance of ruin, excuse me, ruin because of this drawdown. If you have lots of drawdown and if you have taking a high leverage, then yes, it will create a kind of a scenario where you have lots of drawdown, which is not being very easily captured in the Sharpe or the Sortino ratio. So what we do, we create another kind of what I would say a ratio, which is called Calmar ratio, where you calculate your returns divided by the maximum drawdown, and these returns are being taken over the 3 years. Why we are taking over the 3 years? For a very simple reason, you might not have a maximum drawdown which you see in 1 year or 2 year, or at least we assume that in 3 years the strategy would be giving you a kind of a maximum drawdown. If you have a larger the data, better it is. It gives you the idea that okay, if you lose in your maximum drawdown 45%, here it's something like you can lose 45%, and on the returns you are making something like 200% returns. So you know the ratio, okay, this is the ratio which my strategy is making. So to make 200% of my returns, you are also having the risk of 45%. So it's something like this. If I go back to this diagram, you might say that in an actual scenario rather in this experimental scenario you are investing here and you are ending up here, but this is T start and this is T stop. Now this is your theoretical, but in a real market you might have started entering and trading out here. So if you have traded out here and you would have seen some kind of a 45% drawdown or your capital which you have invested, it could have created an havoc in your mind. So how to deal with this is the idea that you should know that your strategy is being prone to such kind of drawdowns, and that will give you the idea. So this Calmar ratio gives you a good idea about how drawdown has to be taken care of, because if you know that a Calmar ratio is something like 200 versus 45%, so any day, any given day, you can have this 45% drawdown, which can create a problem to your strategy. So how you deal with it, it is how you create your risk management around your various ratio scenarios. Sterling ratio is something which is returns divided by the absolute of average drawdown minus 10%, generally quoted for 3 years. So here what is being done is that rather than taking the maximum drawdown but the average drawdowns, the months which are negative, so days which are negative, and how the prices have gone down, how much money you are losing, you take out that average and you minus the 10% and see. Basically it is again kind of averaging the drawdown, because what might happen is your strategy, because of some reason, something happened, it showed you the negative drawdown once and it didn't show you again. So you would be penalizing your strategy for again and again because of this one mishap which could have happened in the market, and it would have lead to you a kind of scenario which makes you very fearful. Maybe a scenario could be something like let me say, like if I look at in the previous history, there could be say a circuit in the Indian market which could have been causing some kind of a maximum drawdown, or maybe something like the US ceiling which happened in 2011. It could be just a kind of an event which is one-off event and which makes you feel that, oh, this strategy is so bad, it is, I lost so much money, so it's not good. So to avoid those kind of scenarios where you could have seen a maximum drawdown because of one-off event, we have also another ratio which is called a Sterling ratio, which tries to average out the drawdowns and come up with a parameter to have a better look on the drawdowns. So then we have the relative return measures that are like up capture ratio, which is like fund returns when the benchmark returns have increased. So it is something which is being termed as relative in sense because we are measuring the returns of the fund based upon how they have performed with respect to the benchmark. With benchmark is either it could be Nifty or any other S&P 500 if it's in US or Dow, it's whatever you are using to benchmark your performance. So this is majorly used for the a mutual fund industry where they have to show that they are stock picking and their method of investment has always been a kind of superior strategy vis-a-vis just investing in a passive fund, and they can show the better returns. So in those scenarios we look for on those returns where fund returns when benchmark return has increased. Therefore what is the benchmark returns, and when the benchmark returns have increased, that is what is the benchmark have been positive on those days, how the fund has increased, and vis-a-vis when the benchmark returns, which is being sum of the benchmark return when the benchmark has increased. So it gives us those point whether we have up or down. So up number of periods when the funds return increased when the benchmark increased, and number of periods. So we look for those numbers. Okay, we say 100 times in a year the benchmark has increased, and out of those 100 times, how many times the fund returns have increased, whether it has increased 100 times or it has increased 50 times, 60 times, 90 times. So we know that okay, that fund has always when it is been increasing, the fund has been also increasing. So a percentage ratio, that is a proficiency ratio, number of period when the funds return outperform the benchmark when the benchmark returns increased, and number of period when the benchmark increased. So slightly what we did another addition out here is that we are looking for those periods only where the fund has outperformed the benchmark. So suppose number of period, again the benchmark return increase is 100. Now we look for those period only. It's not just the positive returns but also where the fund has outperformed the benchmark. So we can also have similar kind of ratios on the downside when the fund has gone down, how much we have gone down, whether we have gone down more number of times or whether we have outperformed the fund when we have gone down. So this is the ratios, total ratios, which will help you out to see in terms of fund whether if you have really if you your returns and how well the days are correlated with the performance of the benchmark vis-a-vis your fund. Then we have a relative risk adjusted returns, which are like a trainer ratio, excess return, again similar to the Sharpe ratio, but here what we look as a beta of the portfolio rather than sigma. We'll try to see how well the beta of the portfolio is. So because since your stock has a larger beta and you say that oh, Nifty made 10% and my stock has a beta of say 1.5% and you made 15%, you say see I have outperformed the market by 5%, look at my my portfolio, it has given me good returns. So in that case you have not just done any special outcome out of it, because it's all that your beta, which was also higher side, has given you that kind of a returns. So the beta, we have to adjust the portfolio based on the beta, that it's not just that the stock has a higher beta so you try to show, or rather any fund manager try to show that we are getting a better returns. So to try to avoid that anomaly, the trainer ratio has included the beta. It's a measure of return. So trainer ratio is a measure of return earned in excess of what which could have been earned on the riskless investment, that is RI minus RF per unit of the market risk, where is the beta of the market risk. So what is the beta of the portfolio? Based on the beta we look for that okay, more than beta it should make. So if the portfolio itself is designed such a way it has a beta of 2 and Nifty give you 25% and you have received the 50%, there is nothing special which have been achieved, since you have just moved what the beta would have given to you. The only difference between Sharpe ratio and trainer ratio is that the latter uses beta as a measure of volatility. Excuse me. Then we have a measure called RAROC. RAROC is where we have a risk adjusted return on capital. That is your expected return based on the value at risk. So VAR, I hope you guys know what is VAR, and based upon what is the value at risk, upon how much value at risk in percentage terms, and what is your expected return. So we try to calculate whether our expected returns are also taking care of value at risk. Otherwise, we see that how much of our returns get wiped out if the value at risk scenario gets triggered. So any investment risk is traded off against benefit. RAROC gives us a picture of returns on several different investments with a varying risk level. So what I have tried to give you out here are the various ratios. So I started with the Sharpe ratio, which just looked at the standard deviations, and then we moved on to the Calmar ratio, which talked about the various benchmark related, and then we moved on to the how we can just adjust based on the risk in the market beta as well as the VAR. So the idea out of here is to look at the various ratios. The thing will come to is like, okay, how you interpret these ratios and how you use in the strategy, and that is something once you have worked on various strategies, we have looked at various ratios, we can decide upon, okay, this strategy is working well and this strategy is not working well. To just give you an example, like if you look at the Sharpe ratios for the HFT scenarios, the HFT strategies, what you will find that, and I can also leave you with the question, you will see that the various high frequency strategies have very high Sharpe ratio, since their returns are quite high, RI minus RF is quite high, and maybe you can say comparable to any other big strategies, but their sigma, that is a variability of the returns, is quite reduced. And with the variability of returns quite reduced for the high frequency strategy, the Sharpe ratio for that particular strategies is quite high. So how you compare them, that is the question which comes out, and I would leave to you to think about it, how you can look forward to understand the high frequency trading strategies in terms of Sharpe ratios, in terms of different ratios we discussed about. So various ratios have their benefits, they do have their negatives. Is how we identify them and how we use them is that will make our understanding better. See, the idea always remains is that you should know where your system can fail. You know that there is a high variability in returns, my system will go bad. You should know that my system has a very problem of a maximum drawdown, it can go bad there. Or you can say that my strategy works very well normally, but when the VAR situation happens, all my profits are wiped out. So to take care of those conditions where extremities can happen, your strategy should be capable enough of handling this. And all these ratios have been created keeping that in mind, that the outcome of this ratio can give you some kind of a picture where your strategy can get stuck. So I hope this gives you a glimpse of how you evaluate your strategy and how you should be looking forward to going more into details and understanding them. Now what I'll do is I'll also look forward to give you some idea of the money management, and in the money management, which becomes a very important aspect, is a trade sizing. So you have a strategy, you have decided upon, okay, my Sharpe ratio, my trainer ratios and my RAROC all are fine, my strategy is giving me good drawdowns and not giving me anything. Now how should I look forward, how much to invest? My strategy is fine, but how much I invest? So the question which is very important is how you decide upon the amount. So one way is adopt trade no larger than let you sleep at night. So what happens is people say, oh, this is the amount I can easily bear. If I have 100 rupees, if I have 100 rupees, 100 rupees, I will just bet something like X amount of percent money. So I will bet only, let's say 50%, and I will just keep that way. That is something I can do. So there is nothing about it. So you keep on deciding upon whatever amount you feel like. Other is margin plus drawdown. So what you really do is, another approach could be like, oh, we discussed about the equity curve. When we discussed about the equity curve, we say that, okay, I have a margin, a maximum drawdown of X%. So you say I will keep X% for my drawdowns plus Y% of my extra sum margin, and I will use that much of a fund for my trading, and I should always have this much amount of money in my bank, and rest I will keep on trading. But does it give me the best optimal solution, or does it give me the idea? We can see. Then the third one is a fixed fractional. So what happens in fixed fractional scenario? What you say is that I have, say, 100 rupees to invest. Per trade, I will not risk, say, more than 2% of my portfolio. So per trade risk is, say, 2%. So that will be equal to, say, 2 rupees. So maybe let's make it a bigger number. So just say 10,000. So if it has been a 10,000, then I would say that I will not lose more than 200 rupees on my any particular trade. Now you say that I have a stop loss on every trade of, say, 5%, and stock is trading at, say, 100 rupees. So your stop loss amount per share is INR 5. So based on this INR 5 rupees, which you can you want to cut your share, and the total amount you can lose on particular trade. So total amount that you can lose for a particular trade is something like 200 divided by 5. So you will say that 40 shares is what I will invest. So your amount of investment, the number of share you have to invest, that is 40 shares, have come from these factors. Rather than thinking these 40 share ad hoc, these come from these factors. So once you have decided upon how you will make, is something being decided upon this factor. So what you do is here is that you know that, okay, I will be investing 40 rupees, and your capital will grow accordingly. So if you have fixed returns and fixed losses, so you can always say that if I make X return and Y returns, you can create a series which can give you your expected value. So this is a scenario where if now you make, suppose, some profit out of it, say 10% profit. So if suppose you make 10% profit out of this, 10% is equal to something like 40 into 10% of 100 is something like 10 rupees. So you make 400 rupees profit, which will be eventually add up here. So now you have your money base as 10410, and now you will again apply the same rule of 2% and the stop loss of 5%, and you keep increasing your fund. So in this way you are not taking the risk more than that, and you have assumed that your portfolio will not move lose much than that, and you take a strict stop loss. So you decide upon your shares and you work on. Now there is something called, which is a fixed ratio. Fixed ratio is something slightly complicated. Let me just give you an idea how a fixed ratio investing works. And if you really want to learn about the fixed ratio investing, then you can go and read about, I think, Mr. James, I don't remember his name, but there is a very famous book called The Trading Game, where he talks about how you can put up money. So he introduced this concept of fixed ratio. Sorry, I forgot the name, but it's very much available on the net. You can find it out. So what he says is that we decide upon a particular delta. So what I'll just explain to you what is delta and initial amount. So, and I keep on increasing the lots as when as I make the delta. So what happens here is, suppose my delta is 100 rupees, my initial amount is, say, 500 rupees, and my initial lot increment is 1. So what I will do is, I will first trade with one lot and my total amount, that is my equity, is 500. Once I make 100 rupees, that is my delta. So once I have an extra 100, when my equity moves to 600, I will invest and I will trade with 2 lots. So now I will see my number of lots which have started increasing, and equity curve is also increasing. In the third one, what I will now wait for, I will wait for 600 plus 2 into 100, that is 800, and then I will do a 3 lots, and so on and so forth. So on the fourth time I will look for 800 plus 3 into 100, that is 1100, to make my 4 lots. So as and when my equity curve starts increasing for 500, 600 and so on, 800, 1100, I keep on increasing my number of lots. So if you are a very aggressive trader, then you can keep a delta very low. I could have kept the delta at 50, 20, and with this, if I have kept the delta low, my equity would have grown more faster than and my number of lots would have grown more faster than what they are growing right now, because as and when I increase to 2 to 3 lots, the amount of money which I would be making would be increasing exponentially in that same region. So this is something which is being propagated by as a fixed ratio. What are the benefits? The benefit is that when you are investing with a lower amount, so this strategy is very useful for the retail traders as well as those traders who are new to the trading and they are increasing their position in a particular trading strategy. So what I am assuming here is that you have a strategy which is have a positive expectations of returns. Once you have a positive expectation of returns, the money management strategy will help you to maximize your returns. So it is mainly for the traders which are starting with a smaller amount and with the smaller money, as because over the period your total profit and the total number of lots increases. So it is being very useful for those kind of trades. And what is again something like which we have to take care is, I talked about delta. So what you guys can do is, when you are working out this delta, where you are looking forward to have extra amount being added to your portfolio before you move to add extra lot, it could be function of something like a drawdown. So what people say is, if you have make it a function of drawdown, so that you know if you lose something amount, the delta will cover to you. So your maybe delta and initial amount will cover your scenarios where you do not have a risk of ruin. So this is how you can decide upon your deltas and initial positions, and you can start trading based upon a fixed ratio. The amount of money here will increase quite significantly as you move ahead and progresses with this trading system. Okay, so these are some trading methodologies which you guys can use to create better strategies. I have a small, not much of a time, but I can show you, if you go back, that if had you invested the same amount of capital again and again, and say only 2% or something, like you have kept your number of lots constant, the amount of money made is not much. Whereas once you have using this kind of a fixed ratio scenario, the amount of money which you can make is quite high, and simply because we are taking the what we call is the use of compounding, which comes out very handy. So if you are trading over with the same lots, say X lots over the period of years, you might not end up making much money, but with the compounding which take care of your drawdowns and stuff, because this delta should be very judiciously chosen based upon what kind of drawdowns and what kind of strategy risk you have. So based on those strategy risk, you create your delta and you start compounding your money so that you are not in the risk of ruining money. Then some methods that don't work It is something which is being people talk about, so I'll just give you the ideas. Is the martingale method, that you increase position size after a loss and decrease after a win. So what normally happens is, if we look at a very simple scenario of head and tail, a very simple strategy that some people would follow is something like that. Assuming you have infinite money and you are playing a game of, if you are playing a game of head and tails, and you are always betting on head. If you bet on head and if you win, you get 2 rupees. If it is a say tail, you lose and you will lose 1 rupee. So in a say first chance, you bet 1 rupee and it comes as a tail, so you will lose 1 rupee. In another chance, second chance, what you do is, you bet 2 rupees, and when you are betting 2 rupees, again tail comes, so you will lose 2 rupees. In the third chance, you will bet 4 rupees, again tail comes, you lose 4 rupees. In the fourth chance, you bet 8 rupees, and suppose head comes, you make 8 extra, so what you would have lost have been -7, and by the time you would have made 1 again. So again you start investing with 1 rupee. So this is what is called a martingale way of investment in a very simplified scenario. So whenever you make a positive, you double your position or you increase your position with some amount, and when you make a loss, you again keep on doubling. If you are winning, then you decrease your position. This kind of scenarios again have a problem which we'll just discuss. We will be just discussing in few moments. Then we have an anti-martingale method, which is opposite. You decrease your position with every loss and you increase your position with every win. So if you have a kind of scenarios or strategy which keeps on making profits once it goes into a profit zone, then you can say that, oh, my strategy makes profit once it has gone into profit zone. I'll go for an anti-martingale method where I'll just keep on increasing my bet size as my strategy is winning. So that is called an anti-martingale method of investing. Equity curve method, increase size when your equity curve falls below its moving average, reversion to mean, or increase size when your equity crosses above the averaging. So you trend the equity curve. So what we say that is, suppose we have this kind of an equity curve and I create this kind of a mean. So if it goes below it, I will decrease the position, and if it goes up, I will increase the position, and so on and so forth. So this is what we talk about in an equity curve method. Martingale and equity curve method both assume dependency between trade. Now, as the reason I said that I will explain to you why it will not work is that martingale and equity curve assume that all trades will come together. As I already said, when you invest martingale and you are getting tails, you would be thinking that, oh, I will surely get ahead soon as possible, let me keep investing. But the assumption of infinite capital is not true in the real world. By the time you had a 10 loss, you would have been in this scenario, you would have been investing something like 1,000 times the share, 1,000 times the amount you would have been investing in your first trade. And had it been that something like a lakh of rupees, 1,000 times of lakh rupees is 10 crores, 10 crores, yes. So you would not be able to invest 10 crores in that particular trade to get back your 1 lakh rupees. So the martingale scenario becomes difficult in those ones where we assume that there will be head soon, and I keep on investing based on tail. Second is also equity curve. What we are assuming out in equity curve is there, once it has gone down, it will again come up. Maybe it will remain here for a very longer time and it does not come up. So based on this, we can say that, oh, the equity curve is again assuming some kind of a dependency. We are saying that it has mean reverting toward the trend, and if it is a mean reverting toward trend, it will come back. It may not come back. In most cases, trades are independent of each other. So what happened in the last may not be something which will happen in the future. Odds of next trade being a win or a loss are not related to whether the last trade was a winner or loser. If your system has something, maybe you can use it. Maybe if you create some kind of a system where you can find out a statistical evidence that your last trade is affecting whether the next trade would be a win or lose, then yes, you can have your trading system based upon the above martingale and then anti-martingale. But If it is not, then the anti-martingale and martingale as well as the equity curves will not help you out. If trades are independent, you cannot determine the likelihood of the next trade being a win or loss and based on the previous trade, and hence the martingale trade, which we assume that previous was a loss, hence next can be a profit, that assumption goes for a toss. So once you are creating some kind of position sizing, you have to also see that whether you have not fallen into the trap of some creating using some kind of a history information which might not be holding true. Like in martingale, we are assuming that the trades will be, what I would say, trades are related, but the trades might not be related, and you could have 10 times where you would be losing out on the money. Hence, it is advised that you look for those kind of methods where you are not bound by the dependency of the previous trades. So before we move ahead, and I'll like to introduce to you something which is called a Kelly criteria. I hope you would have heard about it. It is a fraction, how much fraction you should invest, how much money you should invest is you also can be determined, like we talked about 2%, 3% of the fund. So how you determine how much fixed fraction should we be investing in a particular trade, how much you should be investing, is being given by the Kelly's formula, where F is the fractional amount, P is the probability of win, and W, win and loss rate, is the how much money you make on a win, and loss is how much money you lose on a losing trade. So based on this, we have a formula P plus 1 into B plus 1 into P minus 1 divided by B. So which gives us a formula number which talks about how much you should be investing in something like a betting, where you keep on again and again trading. Something like we talked about a 2%, where we had some kind of thought, okay, let's invest a 2% of the market. So the Kelly criteria gives you an idea how much you should be looking forward to risk. So this is another idea which you can use while you are working on the portfolio management. So that is about the money management. So what I have tried to give you idea is that you have to look at the position size based upon the various factors. So your position sizing is not only just based upon how much money you can make, but it is also being based upon how much money you can lose, because on those losing days you would be requiring this trade size information to come to your rescue from the bad situation and help you out to not lose much when you're going that stock. Because if you are doing any kind of a trading, be it a quantitative trading or any other trading, you will have those kind of scenarios where it could go rough, and in those rough scenarios these ratios or this various the trade sizing comes handy while helping you out to manage your risk. So that's about the today's webinar. And it says something, yes, remember I thought something to give it to you. Money can't buy happiness, but yes, it pays for lots of anti-desperants. So of course, in every strategy we always look forward to make money, and that is what our advice to our students, to look forward to see how they can create money in a less stressful method. That is what our QuantInsti and EPAD is aiming at. So just to give you the basic idea about the EPAD, which is a course which goes into making your trading more professional, making more systematic, because if you have a systematic trading, I can assure you the amount of stress we see in a normal trading gets very easily handled. See, it's something like we have to know what can go wrong, and using the methods which we talk about here. I just gave you a few ratios and money management, and I talked to you about what can go wrong, and to avoid that what can go wrong, we have designed this course to help you out to more trade in a very systematic way. So the EPAD course, which is being conducted by QuantInsti, has three part of it, which is statistics and econometrics, financial computing and technology, algorithmic and quantitative trading. So first part is statistics and econometrics, where what we do is we use a basic stats as a probability and distribution, statistical inferences, linear regression. So we talk to you about, like I gave you the idea about say Sharpe ratio, sigma r, and I talk to you about various terms out there, how you really calculate them, how you really get to the understanding of each term is what we carried out in basic stats. Then we take you to the more advanced stats methodologies like correlation, co-integration, ARIMA, GARSH models, and multiple regression, and then time series analysis, where we talk to you about all the higher stuff like stochastic maths, how you price stuff, how you talk about the causal causality, where you look at how one series will be affecting the other series, and we talk about the forecasting. Apart from this, we talk to you about, which is another branch of our course, is financial computing and technology. So what you would be learning out in stats, you need to be practicing out, and the practice is very well being done using a programming. So you will be given introduction to the programming language, programming of the algorithmic trading platform. So you will learn about C, C++, and then you will start learning how you can program on the algorithmic trading platform. And linear regression will be small example which will be taken there. System architecture, we will teach you how any algorithmic trading structure works on, what is system architecture, understanding of algorithmic trading platform, and how you really handle the data which is coming into your system, because it's an HFT data and creates lots of situations where how you can be handling such a huge volume of data. Apart from this, in the computing part, we teach you Excel and R. In Excel, we teach you Excel plus VBA, and with the modeling, which are the sophisticated modeling which we will be working on, is being using R. So you will be introduced. It's free open source software, so we teach you how to use it, where various libraries. Our experts in R will take you through various ways how you can implement the statistical methods in R. Then when we have talked to you about various stats and how computing, there is something like we gave you the ingredients and now you need to create a pudding. So we also teach you how to create the pudding based on these ingredients. So we talk about various strategies like statistical arbitrage, market making strategies, execution strategies. We talk to you about forecast and how you can make an AI based strategies, machine readable news, and trend following strategies. So whatever you can think of is being in a different kind of scenario of trading, we teach you how you can really work around, and we can see what are the various strategies you can implement based upon your temperament. Then we talk to you about the derivative and market microstructure. So we have option pricing model. We go into options, detail into options, time structure of volatility, dispersion trading, volatility forecasting, interpretation, managing risk using Greek, position analysis, order book dynamics, and market microstructure. And lastly, we talk to you about managing your loyal go operations, because once you have created all these things, you still need some things to manage. You need inform how to handle these. So what you really do is you have a hardware and network, you have regulated framework, then your exchange infrastructure and a financial planning, handling of the risk management, and automated system part of it to give you overall the managerial perspective of how you handle a desk. About the program, it's a weekend program, so it is being designed for the working professional who can be having time, and they can fix a slot in Saturdays and Sundays, so that it will help them cope up with their job as well as with the work. It's a 4-month program. It's, I think, slightly mistake. +2 is I think you can project, and yeah, means 4 months will be something your classes and your practical session. +2 will be something like where you will be completing your projects and you will be interacting with the faculty. It's a practical oriented program. We assure you that we will be asking you to do the assignments, and we will be sitting with you to do the assignments. Many faculties will work with you to create your own Excel sheets, and will be working to create your own codes, so that we assure you that you get hold on how the trading is done. So that is why it's a very practically oriented course. 100 hours, contact hours, including the practical sessions. Convenience, the best part of it is conducted online. So if you are not, if it is not possible for you to come down to Bombay, we have our infrastructure where we can always log in from the outside Bombay, and you will have as good as the class experience where you will be interacting with the faculty and knowing more about your doubts and clearing and learning more with the faculties on an online basis. Open source, the packages we use like R, which is very much used, is an open source, and it gives you the easier way of calculating at your own place. Virtual classroom integration, as I talked about, that you will be interacting with the classrooms and classroom participants, classroom faculty, and how you really, if you are not being able to come to the classroom. And then you have a student portal where we have the students come along, they do discuss, they talk about their projects, they talk about their queries, and they get to know. So that's the collaborative learning which we believe helps out while you are working with a students portal. Faculty supervision, I think that is in the previous students can talk about. We can always discuss with the faculty whatever doubts you have. Even if you have not passed out for the course, you are always welcome. We can discuss, we can sort out what kind of issues you have in problem. It's not just the contact we are having here for the 6 months. It's a lifelong kind of associations we are looking for. Means if you are learning, we want your learning to be complete and wholesome. And when you are for that, you can always talk with the faculty in the future. That depends upon how you really move up. So, and placement assistance, yes, we help you out if you are looking forward to change. So we talk to you, we take various mock interviews, we talk to you about what are the things being talked about in the various interviews, because see, for the faculty out here has been worked in a various industries. Some have worked in banks, some have worked in brokerage, some have in the proprietary desk. So all the areas where you can think about that trading would be applicable, the faculty would have worked in those areas. So, and they can give you the direct assistance in what kind of placements you are looking for, and they can let you know what kind of qualification these desks usually look for, and we can prepare you for your interviews. And maybe if we can also pass on to you the few interview queries that do keep coming to us. So we help you out in your placement process. That is something which is going beyond the curriculum. This is the date for the next batch, which will be commencing very soon. So we have the last date, 20th July. If you are waiting, I think if you really were waiting for it, how it will happen, I gave you the glimpse. So I gave you a glimpse of a very small section that will be a very small part of the whole course. Just one lecture. I gave you the small part of the lecture, how it looks like and how we really talk to you about the various information. We would take up a strategy and discuss the strategy in a real life scenario, but of course, given the crunch of time, I could not take up that right now. But of course, you can work out with the EPAD program. So 20th July 2014 is the date which you have to complete your registration. And I assure you that once you have worked on this program, you will be really having a very good hand on the quantitative finance, and something like understanding of the market will be very thorough. 26th July is the day where we begin, and it's the 21st batch we are going on. I would suggest don't wait much of a time. Go, if you are looking forward for this program, go ahead and sign for it. Our executives and our colleagues will be more than happy to, if you have any query, to solve it out. Thank you. So that is about today's webinar. If you have any questions, now I can take up your questions. Okay, so there are a few questions. Let me start with, okay, Siddharth, let me start from the start. Volume is low, okay. Volume is fine, no, fine. Siddharth, yes, okay, yeah. Which application, Siddharth Seth has asked, which application software is recommended to compute all these major ratios discussed in the today's session? Siddharth, we can calculate these ones in Excel also and R also, as I discussed that when we discuss these courses, these ratios while we are working out sorry, while we are working out in EPAD, we take you through Excel and R, where you can easily calculate these ratios. So that is one software where you can work it out. Hi Hormuz, I think I have that. Thank you. Which applicable software is again? I think Siddharth is done. Uh, Okay, Siddharth, the specific package in R. See, normally there is a, I think, performance matrix. There is a package in R which helps you out to work on these things. But apart from it, what we usually do is we create the returns scenarios while backtesting, and then we just write few formulas and we calculate in R. But there are few packages which work more depthly in your performance. I think there's a performance management or something like that. There is a package which is especially known as some performance which you can use in R. But of course, when we talk about, we talk to you with a very basic thing. So we can give you the direct codes where you can calculate. So it's very easy. Once you have RF minus R and you have sigma, then you can very easily calculate these ones. I hope this answers. Viren Patel, is algo trading makes technical trading more powerful. Okay, Viren, if we talk about algo trading being made more powerful by, means rather technical trading is made more powerful by algo trading, I think let me answer this question in a different fashion. See, when you are doing a technical trading, and in your technical trading, what are you right now doing is you would be trying to create some patterns or some indicators. Now, if you can create those indicators, which are something your indicators are which can be defined in the rules and can be coded, then yes, algo trading will make your technical trading very powerful in one particular sense. That suppose in your technical trading right now, you are witnessing say one or two or three stocks that you would be looking at and able to trade. But with algo trading, once you have systematically implemented your system, you can increase your universe to something like 100, 200, 300 stock. Secondly, in technical trading, sometimes when you are executing your orders manually, you would be having a kind of emotional hesitation, maybe because while taking a stop loss. So if you have to take a stop loss or take a position, your system will be ruthless. It will not have any emotions. It will directly go and trade. Believe me, if you trade very systematically without any emotions, your strategy can give you very good returns. Provided, yes, technical trading, you just create your rules, more back test them, you create a code for trading, and you can directly go. So in that way, yes, algo trading will make your technical trading more powerful. What is a what is a right proxy for risk-free rate as used in Sharpe and Trainer ratio? Okay, good Siddharth. Let me ask you, what is a risk-free rate? Risk-free rate written is why we use a risk-free rate is only because what we are trying to get you here is that how much opportunity cost you are missing. That is, I can, if I put up say in Indian markets, if I have a money and I wanted to get what is the maximum risk-free rate returns I can get in my Indian markets. So what I can do is I can go and invest in something like the government FD. So FD makes me something like 9%, and if you are taking the tax, so you cut the tax, or if your RF minus R is without tax, so you take a 9% or 8% or whatever risk-free returns. That is something which you can directly go and deposit in the bank. You can make is your risk-free returns. So that is what is being referred to as risk-free returns in Sharpe ratio and the Trainer ratio. Okay, we have a question for Kavan Sejpal. He says a question on EPAD course. Do you cover HFT strategy implementation with a focus on reducing latency? Yes, we will have HFT strategies. We talk to you about how you can reduce the latency when we talk to you about, when we'll be talking to you about various hardware and hardware and a software innovations, and what kind of a different aspects you can do while you are coding your strategy and how we will be doing it. So let me go a step back. If I talk about the reducing the latency is a two-pronged process. The first process will be something like when you would be doing it on the hardware level, but what kind of machines, what kind of card, what kind of networks, what kind of a colo you are using. That will help you out to decide upon your latency numbers, and is upon your what kind of coding you are doing, how much your data packets, what you are getting in data packets, how well you identify, how fast you identify. So these are two kind of latencies, and we talk to you about the latencies, how you can reduce at a different level. So we have lectures about reducing the latencies and all. I hope that answers your question, Kavan. Viren Patel, approx cost to set up an algo trading system for individual trader. Viren, it is something which is very much it is very much subjective. Suppose if you are looking forward to do some kind of a strategy where mispricing, small mispricing like arbitrage, or some kind of a very high frequency strategy, if I mean to say, where you will be working with a high frequency data, it will be taking you in a few lakhs up to even few rather few it could go up to good lakhs, rather not few lakhs, good lakhs, or even up to crore. So if you are looking for making the speed as your competitive edge, then you have to invest very heavily in the technology, and that cost or something. However, if you are looking for to automate your strategy, which is also part of algo trading strategies, where you are not very much concerned with the speed, but you wanted to have an automated execution, that I don't think so will take you more than few lakhs for setting up. I think the cost is going down with the many brokers providing you the platforms to trade algorithmically on them. So this is, I think, not more than few lakhs if I go about in for setting up the trading system for an individual trader. I hope that answers your question, Viren. Sir, which is Shanmuga Sundaram VS, in fixed ratio, what we will do if equity keeps on decreasing? Okay, good question, Shanmuga. What I said to you in starting that we know that our strategy is a positive return strategy. Suppose we start with a one lot and our equity keeps decreasing and it does not go up, that means it shows that there is some problem with the strategy, not the money management. Hence we should revert. Now what might also happen, you traded at one lot, moved to 2, 3, 4, and it again started decreasing. So once you have 4, so we know what is a threshold for the 3, and if it crosses that threshold, you come back to the 3 lots, 2 lots. So you scale back your lots with the numbers like I discussed, 600, 800, 1100. So if you go below 800, you try to trade with those numbers which is meant to be traded between 600 and 800. So you keep on changing your position sizing based upon in which segment you are following. So that way, excuse me, in that way you know that how much you would be trading, and if it is continuously decreasing, then of course you have to go back to your drawing board, check out how your strategy is working. If your strategy has something wrong, that it has giving you negative returns, and if it is not negative returns, then of course it will fight back and it will come back and start moving up again. I hope that answers your question, Mr. Sundaram. Okay, thank you. Thank you, Kavan. I hope you enjoyed the webinar. Any more questions, participants? Anything else? Okay, so I hope you had a nice session. Try and look at your strategies from the perspective which we talked today in the performance ratio as well as the money management ratio. If you want to learn something, we are always here, so you can always contact us. Have a nice day. Okay, bye-bye.